Hello traders, we are going to take a close look at the sluggishness within the market internals as of late and discover this one sector that is poised for a very strong rebound because of this economic metric. I'm Jay from swimtrading.com and I will catch you in today's video. See ya! Over the weekend, I have did some digging, some research, and then I thought, okay lah, let me go and do some digging and see whether is there any chance of a market pushing higher and what are the chances of it pulling back. And as such, right, I think it is quite close to what we have shared 2 weeks ago, which was very similar to that of 2021 with the market breadth pushing high, staying high, and then the prices are just going with lagging internals. The internals have not changed since last Friday when I shared with you at the physical gathering. The internals didn't change. The internals are still there. So I want to kickstart the session with the price level and then also revisit some of the internals. So if we were to look at VIX, right, you can see that as prices are going up and up and up, VIX is yesterday. What happened, right? Yesterday during this session, over here, this huge bullish session, right? So that was on a Monday, Monday 29th of January. You can see that the VIX literally shot up first, and then after that it pushed back down. So over here, what I'm seeing is actually increasing level of hedges. So this is one of the factors that we discussed last Friday, which didn't change. It's still here. This is a developing case. I'm looking at it. So the higher it goes, the hedging activity actually stayed constant, and by right it should drop, because if everyone thinks that this is going to continue on and all that, by right the VIX should come down lower. But anyway, I'm looking at this developing trend, and if I were to do a US market comparison, right? Okay, so let me just switch it back like that. If I were to do a US market comparison, then you can see that ever since start of the year, all right, so I zoom into the start of the year over here, all right, over here, this is on the 2nd of January, then you will realize the name labels, you can see over here what has been leading the overall market. Obviously, this is the strongest, which is NDX, all the way down to the small ones, the Russell, which is still as of now underwater. All right, as of now underwater. Then what has this got to do with everything? What has this got to do with the overall market or the internals per se? Well, I think that if there's a rotation, okay, the rotation will be short-lived. Okay, rotation will be short-lived. So can everyone just type rotation in the chat? Can everyone just type rotation in the chat? So I want to see how the Russell plays catch up. All right, I want to see how the Russell play catch up. And if there is a rotation, what's happening is usually it will go here, and then after that go back again. So some of the companies that are small, they are beaten down right now. I think those that are with fundamentals, fundamentally sound companies, those that are small companies, they in the next chance they possess it's like beaten down already, so they possess a good chance for the market, in the rotation to at least prop back a little bit in the next rotation. Okay, so this is one part on the US market. On the market itself, this is the key level that I'm watching for. On the futures, right, you can see that this is 4993. All right, so we have X amount of space away, X amount of distance away from R2, whereas on the S&P 500, on this S&P 500, you can see that we are quite close to the next pivot at 4950. Okay, so this is the cash market. This is spot market. The distance away from the pivot is around that one. Both are around that one. All right, of course, the futures will have slightly bigger, longer distance, which means I wouldn't be surprised if let's say prices approaches here and it broke above, all right, prices approaches here and then it broke above, then fail to hold above there and then subsequently have a FBO. So the pullback, don't expect like fierce pullback, because like I said, this market this year resembles that of 2021, where as far as I'm seeing, the market literally for the past 2 months, 3 months lah, November, December, and now, right? Go up sideways a little bit, go up quite a lot, sideways, never even pull back down, go up, come down one session a little bit, go up, come down, stop hunt, and then after that, go up again, shallow. So literally this whole December was like going sideways, then now go up again. So what I think is more probable is a range of somewhere around on the futures, right? So I just gonna make use of one instead of switching all over the place, right? I'm gonna make use of ES. I do think that, okay, I do think that if it goes up here, if it goes up to R2 and gets stuck, if it pulls back down, somewhere around 4,900 on the S&P 500 futures, or come down further will be 4,800. Because remember, the December's low, or rather December range, this range that was formed in December to January, it was a base where prices just broke out from. It has not been retested. And I think you made, two schools of thought. The one school of thought is that some breakouts, they will never retest. Fine. But this is not the time period to do so. All right. Every market has a time period. So from cyclical analysis, we know that, right? Every market has a time period. If you say that now is probably March, April onwards, then yeah, March, April onwards, maybe you just run and then run all the way, July, yes, maybe run. But this period, unlikely. I'm not saying impossible, but what I'm saying here is unlikely. So these are the key levels that you need to watch out for. 4,800. Okay, so this range, if it pulls back and with the upside for futures, so for futures, correspondingly, you just work back for the spot price, it's around 5,000. I think the futures will fall short of the 5,000 price. That being a round number as well. So these are the levels that you need to watch out for the next 2 to 3 weeks. Is this clear, everyone? Is this clear? If this is clear, have me type clear in the chat. Good. So what is the next thing that I wanted to bring to your attention? The next thing, right, was what I've dug up over the weekend, the case for a bullish, a bull market, all right? The case for a bull market. So what I thought about, right, was what if this year there wasn't any recession per se? What if this year there wasn't any recession or a slowdown? How would we know that? Well, this year, I think what would be of attention. Last year everyone was looking at inflation rate, right? Last year everyone was like inflation. That's all they look at. This year, besides the GDP annual growth rate, last quarter was good. The advanced GDP on the 25th, that was a Thursday, right? So on the 25th was good. It came in 3.1 instead of the expectation. Okay, so this is not bad. All right, the annual growth is not bad. So I'm watching developing trend, and it will be even more meaningful. For every GDP announcement, right, you have advance, you have the preliminary, then after that you have the actual. The actual, or so-called the final. Which one has the most impact? The advance. So I will watch out for the advance announcement in, I believe this is April, because April will tell us how did we do from January to March of 2024. So January to March of 2024, April we will know, and the advance number will tell us that. So I want to watch for the trend of this. All right, I want to watch for a trend of this. This is one. The second thing that will affect or impact, right, is I want you to watch this year, the important news. Remember, in our program, we discussed a series of important news. I say that they will change. And I also said that when they change, I will be the first to inform you, right? So what are we going to look at? Inflation, I can more or less say that or think that it is behind us, right? Given that they raised the interest rate to 5.5%, inflation dropped from 9.1% in June of 2022, then all the way down to 3.4% right now. I thought that was quite marvelous. Still a tad away of, a small distance away from the long-term target of 2-ish%, but I think it's good enough, all right? So they are going to hold the rates for as long as they can so that this inflation rate can inch lower. Of course, you look at core PCE prices as well. But this year, right, when recession is in so-called in play, right? When recession is in play, what people look at besides the annual growth rate is also the unemployment numbers. The unemployment numbers, the non-farm payroll, I think this year they will become slightly heavier weighted as opposed to last year. It was like a non-event. Because I know on the news right now, so this is sentiment analysis, right? I talk about in our program, we discuss extensively on FA. We also look at TA, we look at CA, cyclical analysis, and SA, sentiment analysis. So this is part of sentiment analysis. I think this is what's going to sway the sentiment this year, given that the focus will be on whether are we heading into a recession. And these are the markers to tell us whether we are going to a recession. And everywhere else right now, if you look on news, right, you would have heard of those big corporation, technology, etc. All these companies are going through some form of retrenchment exercise, right? How many of you have heard that, read that somewhere? Can you type me in the chat? Some form of retrenchment exercise going around. Yeah. So this, no doubts, right, creates a little bit of fear. In the grand scheme of things, the unemployment numbers are still low. To be fair, it's still low. But it is never the absolute number that kills. It is always the perception that, it's a doom and gloom perception. That is what kills. That is what will trigger a panic. So whether, and humans like to overreact, right? They always like to overreact. Hence, when you this year, right, any changes or shocks, surprises to, I believe, non-farm payroll, unemployment rate, as well as I think there's, together with the unemployment rate, there's this initial claim. Because in the US, those that get unemployed for the for I don't know what the exact terms, but when they get unemployed, then they are able to do claims from the government. The government is going to give them a handout, right? Not bad, right? Asian government, you tan kuku. But what happened is they will track this initial claim numbers, and they only count those people who not recurring claim now, but the first time. So how many of them are first timer? All right. I don't know what's the qualifying period, but yeah, that's what initial claim is about. This is going to affect as well. So this year, I suppose this is going to play out. Just like during the during the subprime mortgage crisis, what actually the market was rallying and tanking against, it was actually the housing starts, new home sales, existing home sales, and things like that. So every different market has a different theme. So I am thinking this is the theme this year, given that there will be recession on the cards. Everyone is thinking about recession, and also whether it will lead to a recession or whether spending power and all this will come down. The first one trigger is always your unemployment, your employment. If your employment stays robust, just like during COVID, right? How can we, in this belief, right? Not some of us at that point of time were in this belief. How come these people, if you recall in Singapore, what happened was every show flat, it was packed from ever since after the what do you call that? After that circuit breaker, right? Every show flat was packed. All the new launches are selling at like hotcakes, 70-80% sold on the first weekend. So everyone was like thinking, where? How come? Why? Because people still got job. Think about that. So it will really change if people don't have a job, So that is a developing thing that we need to watch out for. And I think that's important. Okay? So everyone clear? If you are clear, please help me type clear in the chat. All right, so this is what I want to watch for. Another thing that I want to watch out for is this thing called the PMI. All right, so what PMI? United States ISM, which is Institute of Supply Management Purchasing Managers Index. Now, this has got to do with the next macro theme that I want to share with you tonight, which is part of the digging that I've done over the weekend. So you see, if I were to show a 25 years or max for PMI, or rather the last 25 years, you would see over here that with the exception of huge external catalysts, which in this case, this number here is 45. All right, this number here is 45. For times that they drop below 45, you have the dot-com, that was 2001. You have the subprime mortgage crisis, which is 2008. And then drop below 45, you have 2020, which was COVID. So every of this instance, there were external catalysts and reasons why the survey of these purchasing managers comes in very low, very pessimistic. Now, if this is something that is not so familiar to you, well, basically, what is this? This is the Institute of Supply Management that does a survey with the purchasing managers of the manufacturing companies. So, there's ISM services, ISM manufacturing. So they survey all the manufacturers, the manufacturing companies, the purchasing managers, because the purchasing managers is thought to have a first a bird's eye view or the front row seat to what's happening. So if they don't think that it is going to be good, they are going to obviously reduce their whatever they're going to buy to produce the goods, right? Because if the demand is not going to be so big, then my supply is I'm going to cut my supply Sorry. So this survey, right, anywhere above 50 is expanding. 50 is expanding. Anywhere below 50 is contracting. So in short, right, you can look upon this like optimism or pessimism. Is this understood? Is this clear? If this is clear, type yes in the chat. So if you look at patterns, right, if you do a technical analysis on the PMI in that sense, in a figurative sense, then you will come to realize this. All right, you will come to realize this. With the exception of the huge external factors, right? Most of the floor comes in somewhere below, it's just slightly below 50, slightly below 50 only, somewhere there. It's like maybe 47, 48, thereabouts. How many of you realize this now? Can you type me in the chat if you realize this? So this is where, right, with the absence of external catalysts, and right now there's no COVID, there's no subprime, there's no dot-com, there's nothing. It's just a normal economic, late stage slowdown, overheating, and things like that. So we are somewhat at the floor, all right? We are somewhat at like the near-term floor, and without external catalysts, it is hard for me to to call out like a continuous drop or contraction in these PMI numbers. So how does these PMI numbers translate to a trade opportunity, a trade idea? How many of you realize that industrial stocks, okay, just now we talked about in an event of rotation, okay, in the event of rotation, I think the small companies are the ones that are likely to make a comeback, right? The small companies. But in a rotation, in the next rotation, industrial companies, given the uptake and a pickup in the PMI numbers, they are likely to benefit. These are the companies that are likely to benefit. I'm sure you have heard of me, sharing with this before, saying that every of the inversion leads to a recession. Every of the inversion leads to a recession. So far, it has been 100% predictor of recession. So now it has been the most negative, most inverted it has been. No thanks to the aggressive rate hikes by Federal Reserve. So the near-term hikes are really getting a boost because the Federal Reserve overnight interest rate has already pumped up to 5.5, right? So all your 3 months bills, your all this will have to match it close correspondingly. But people still do not believe that these can be sustained in the long term. Therefore, in the short term, you have 3 months, the yield is high. All right, 3 months, the yield is high. 2 years, the yield is also high. Then after that, 2 years, 5 year, 10 year, etc., etc. So now this leads to what do you call that? A lower in expectation for the longer you go out, the lower the rates they think it is going to be, the interest rate, because it simply cannot sustain. If you do that, the economy will not be able to grow. At some point in time, you want to bring down your inflation. Yeah, I think the market can understand it, right? But if you sustain this, you won't just bring down the inflation, you will bring down the economy. So the Federal Reserve is juggling this ball that I want one thing to come down, and yet I don't want the economy to crash. Therefore, this inversion happens like that. And as far as what we are seeing right now is still inverted. There is no cause for panic yet. Okay, from this point of view, there's no cause for panic yet until it recovers above zero. Okay, can everybody acknowledge this by typing clear? Because I don't want you to panic right now. I need you to know that most of the time the market don't crash immediately, the economy don't tank immediately. It is after when it returns to zero. That means when the yield curve is invert already, then it flattens back. That's where the pain is. All right, possibly. Good, clear? So looking at this, all right, looking at this, it also got me thinking, will there be physical stimulus for the presidential election? Like what Kai mentioned. Maybe, because now is there a possibility? The possibility is always there. Why? Because now QE is zero. All right, QE is there is no expansion right now. Right, there's no expansion. The money supply has been pretty okay. It was down, then it uptick a little bit lah. All right, uptick a little bit. So QE is now at zero. Should the market goes into a frenzy, it tanks further, at least they have that QE at their disposal to, like what they did in 2020, right? When COVID struck, what did they do? 3.5 trillion print, bam. Then you see what happened to the market, V-shape, all the way up. Right? It was like a 35% drop in 19 days. And then after it recovered over the next few months because of the strong intervention by the policymakers. And this is something that I think, like a human point of view, we think in terms of psychology, right? Once you have tried things in a certain way, in one way or in easy way or another, the first inclination when you run into trouble is to go back to the easy way. How many of you agree with this? If you agree, type agree in the chats.